Both climate and job opportunities continue to lure people to New Zealand. Although similarities exist between this economy and South Africa, they can also be starkly different. What should one consider as an investor in these economies? That's why my Interpret analysts join me in the studio to answer these questions. Welcome to the show, gentlemen. Let me begin with you, Kobe. As a South African investment analyst, when you look at opportunities that are in New Zealand versus those that are in South Africa, why would you advise one to look at New Zealand?
Well, I think firstly, Godfrey, to take into consideration that we're becoming part of a global village, so to speak.
Sure.
So regulation is allowing us as South Africans to start investing elsewhere globally, and that includes New Zealand as potentially an investment destination. Now, often what we do is we kind of don't look at New Zealand. We kind of only look at Australia. We don't understand New Zealand. As a matter of fact, if you look at your screen right now, let's just quickly put into a snapshot for you what New Zealand looks like just from a broad economic perspective. You'll see that there you can see the world GDP. You can see how large that is relative to New Zealand. I mean, it really is a very, very small country. And if I just go to the next screen, you'll be able to understand it from a per capita perspective or from a per human perspective in those different economies. You can see Luxembourg, we are very, very prosperous per individuals that are actually in those economies. And then you can see New Zealand. You can see the value that they're creating per individual. I mean, Colin, you lived there for a brief period of time, and you kind of had first-hand experience. What does New Zealand look like from an investment destination perspective?
I think it is an attractive investment destination, but it's a very small investment destination. As we can see from their GDP contribution to the world, they're a very small player, and therefore their stock market is actually very small from a global context. But it is an advanced and quite sophisticated investment market, and there are quality companies listed on the New Zealand Stock Exchange.
And I mean, if you just look at liquidity, I mean, you kind of just look at it from a liquidity perspective. What kind of liquidity is available on that market? Can you freely buy and sell stock on their exchange?
Yes, you can. They've got about 50 companies that are freely tradable. Those will be part of the NZX 50 index, which is kind of the major index in New Zealand. There are more companies listed, and obviously as you go down the market capitalization scale, stocks become less and less liquid and less tradable. But there's about 50 counters there that are freely tradable. And as I say, the stock market there has been around for a long period of time.
Yeah. I mean, you've got a different situation that you've got here in South Africa.
Absolutely. But what I want to know also is just in terms of returns, how do they compare versus, well, first of all, let's begin in South Africa and then perhaps go against the global average.
Very, very interesting in that equity market returns in New Zealand have actually been quite pedestrian, if I can put it that way. It hasn't been a strong growth country, and the market returns have been in line with that. And quite interestingly enough, something we call the equity risk premium, which is the extent to which share returns actually beat your risk-free rate or your cash rate, have been coming down in New Zealand over many years.
Right.
And that's really just showing and indicating that this is a slow growth economy, and the market returns are reflecting that. So it means, you know, you need to pick stocks very carefully. You need to find your stocks. Often you find smaller companies in New Zealand, innovative, creative companies, have been the better performers.
So if you were a South African investor looking to invest outside, like say for instance into New Zealand, what would you be looking for to add to your portfolio, I imagine?
I think look for diversification. As I say, it is a small market. It shouldn't be a large component of anybody's portfolio.
Sure.
But there is value there, and of particular interest is what New Zealand can offer in terms of listed companies that you can't get elsewhere. And some of those would be ports. A number of the ports are listed companies. One of the top companies in New Zealand is Auckland International Airport. You know, if you want to get to New Zealand as a visitor or a tourist, you know, basically going to Auckland International Airport is just about the best way to get there. The other thing that they do offer is different companies such as forestry companies, you know, are listed on the stock market there, and one can get exposure to those kind of sectors which you may not find readily available in other markets.
I mean, maybe just as another look at this market, just look at your screen at the moment. You'll see the returns for the, and Colin spoke about the NZX 50 a little bit earlier on, and that's the 50 largest companies in that economy. You'll see the returns for that market. And what I've done over here in this situation is I've rebased all of these to 100 at the beginning of the period. And you can see that the chart runs really from 2001. For every 100, and these are now in home currency terms that we've kind of invested, for every 100 New Zealand dollars you put in the markets in 2001, Well, there you go. That's Colin's comment just now. Pedestrian type returns. You've kind of haven't lost money, but you haven't made any money by being in those markets. Look at that relative to South African. I mean, we're now comparing it in South African rands, but you know, for every 100 rand you put in the South African market, you've made 400 rand. I mean, certainly an investment environment where equities have behaved as the capital growth instrument that they should be. I mean, let's just quickly look at some returns that you would have gotten out of the New Zealand market. I mean, Colin spoke about the NSX 50 just now, which is the 50 largest companies that are included in that stock market. And so basically, if you invested 100 New Zealand dollars at the beginning of that period, you see with the 100 New Zealand dollars would have grown to basically 200 New Zealand dollars. I mean, it shows you equities. You know, you kind of make money out of those over time. Certainly not been anything as good as South African returns, because from a South African perspective, for every 100 South African rands you put in the market, you would have made 400 rand. Certainly a lot better returns. As a matter of fact, let's just maybe look at what you would have received if you were a New Zealand-based investor, and just look through a range of asset classes here. 100 New Zealand dollars in the beginning of the period. Well, the best performing asset class over time there, and that's now since 1991, is New Zealand or international bonds, up at 595 for every 100 New Zealand dollars you put in. New Zealand shares, for every 100 New Zealand shares or 100 New Zealand dollars you put in, you would have made 495 New Zealand dollars. I mean, international bonds have done far better than what you've seen New Zealand shares kind of do. Is that kind of the environment that you're looking at there, Colin?
It's actually been an unusual environment, because over such a long period of time, it's highly unusual to have bonds outperform equities. I think equities did take a knock, obviously, with the global financial crisis. And yeah, it's been one of those periods in which traditional growth assets have not outperformed. And just like other markets, bonds have done well over a long period of time, international and local bonds. So you haven't got the kind of equity returns out of the New Zealand market that you would have expected. But again, these things do go in cycles, and the cycle prior to that was very, very good for equities. So it's one of those things where, you know, maybe markets get a little bit overheated, have long periods of time where they don't outperform. The other thing to bear in mind is that small company shares in New Zealand have done much better than the actual main index that we're looking at. So that's one thing to bear in mind. Smaller companies have done a lot better than large companies.
I was just going to ask the question, are those returns adjusted for inflation?
Well, you'll actually see that the inflation is actually inclusive in those graphs. So no, they haven't been adjusted for inflation. So those are what we call nominal returns.
Right.
So those would be total returns that you would have received during
the question I was going to put to you is, so if you adjust for inflation, do you get a better return in New Zealand compared to South Africa?
Well, I think still not. Because, you know, South African inflation runs quite hot.
Yeah.
Okay, so we're sitting at like its 6% number, which, I mean, Colin, you know, just correct me if I'm wrong here, but, you know, New Zealand runs a lot cooler than that. So, you know, in real terms, I think, you know, again, their returns are kind of structurally made for that market. And again, when you're retiring in that market, make sure that you invest in that market, because you're used to the inflation. You're living in that inflation environment, you know. I mean, Colin, one of the things that kind of comes to mind here is kind of the structural imbalances they've got, you know, in that economy. And we're talking here specifically about the current account kind of being in deficit. Has there been knock-on effects as far as the market is concerned there, as far as this current account deficit is concerned?
Yes, it has actually been a major issue for New Zealand, is their current account deficit. And that current account deficit actually hasn't been funded by internal savings. So New Zealand has been reliant on offshore international inflows into the economy to kind of balance the balance of payments. And, you know, that's been a major issue for them, because in terms of attracting these foreign inflows, they've needed to actually offer higher returns on their bonds, and they've generally had a relatively high long bond yield relative to other developed markets.
I mean, look at your screen just quickly, just briefly, and you'll see the current account balance there as a percentage of GDP, and you'll see how negative it is, and kind of over a protracted period of time. I mean, obviously, Colin, I mean, this influences savings. It influences how people kind of, because you're saying that people aren't really saving there. Is that not symptomatic of what we see globally?
To an extent, in that the New Zealand government does offer citizens, you know, a guaranteed pension, which is quite generous in OECD terms. So there kind of hasn't been an incentive for Kiwis to actually save for retirement. And as I say, they've been reliant now on international flows. The other factor that has influenced the economy, and that's happening in a lot of developed markets, is changing demographics. They've got an aging population. They've got a lot of pensioners now. You've got less people coming into the workplace, and it is putting a lot of pressure on the government's ability to actually pay pensions, and it's making up more and more actually of government spend, and it's made up. It's been such an issue actually for the New Zealand government that they've actually set up now a sovereign wealth fund to pre-fund government pensions to citizens. Yeah. So it's been one of the ways that they've tried to actually cater for these changing demographics.
It suggests to me, Colin, that perhaps one ought to consider New Zealand when they want to retire rather than when you're younger and you're looking for higher returns.
Look, when you want to retire, you don't just go there and get given a government pension. You know, you do need to spend a certain period of time there, right, and they expect you to have lived in New Zealand for a period of time before you qualify for the pension. Yeah, right. So you can't just go there, you know, shortly before you retire and expect to get their pension. Yeah.
So let's talk about that sovereign wealth fund. Who is so what does it invest in?
The sovereign wealth fund is actually controlled by an entity that's been set up to manage it called the Guardians of the New Zealand Superannuation Fund. It's almost like a separate investment manager, right, that has been set up specifically to manage the fund. It looks like a typical balanced fund, but it has a higher weighting in kind of alternative investments than your typical fund. They have liked the fact that they can invest any liquid kind of alternative investments, things like forestry and private equity, you know, make up some of the alternative investments. And the reason for that is they're only going to start drawing from the fund in 2025, in fact. So the fund doesn't have short-term liquidity requirements, so that's allowing them to invest in illiquid asset classes with a long-term view.
Yeah, I mean, it's not just that sovereign wealth fund, but I mean, there's a thing called KiwiSaver as well, which I suppose is kind of symptomatic of what we've seen globally. It's trying to get people to save for their retirement. It's trying to get them to play like a meaningful part. Because when you've got like these very big social kind of systems where, you know, you've got government kind of providing pension, that's not always the right thing to do, is it, Colin?
No, that's correct. And I say this issue they've actually handled in two ways. The sovereign wealth fund is going to be a big pool of assets that the government can draw on in 2025 to start paying pensions. The other thing that they've done is they've put a national savings program in place called KiwiSaver. It's mainly workplace based, but actually just about anybody under age of 65 living in New Zealand can become a member of KiwiSaver, and that's to spur individual savings and to make sure that individuals also do their part and make an effort to save for retirement. So those two things together is basically addressing the changing demographics and basically, you know, the effect on the government spend as a result of these changing demographics.
Yeah. Kobi, do you think that's something that perhaps could be relevant for South Africa?
Yeah, and I think, you know, and I mean, it's interesting that you mention it because I think that Treasury has gone a long way in trying to understand some of these dynamics. Yeah. You know, firstly, you know, we don't have the unified social system that is available in New Zealand. So if you look at it from a classic LSM kind of perspective in South Africa, they're far more narrowly defined than what we've got in South Africa, which is much more broadly defined. Right. And I mean, with that comes a whole bunch of challenges, which is kind of all those social challenges that we talk about, that the ruling party talks about all the time, and that we need to kind of solve. Now, the question is, what kind of mechanisms do you utilize in order to get people to save for retirement? Yeah. We've got Regulation 28 in the country, we've got retirement annuities, we've got pension funds, but over and above that, national savings is kind of this thing that's kind of luring in the background that they're trying to use as a mechanism, not only for social objectives, but also to ensure that most people have pensions. And I suppose we're talking about quite kind of the same things, you know, as for, you know, if we're kind of comparing New Zealand with South Africa. Look at your screen at the moment, and you'll see the two big mechanisms that they're talking about at the moment. The one is that sovereign wealth fund that kind of kicks in at 2025, and then KiwiSaver, which is really a voluntary-based system. And when we come back from the break, we're going to be looking a little bit more at KiwiSaver and what that in essence entails. Colin, just to quickly, just to kind of ask you, I mean, sovereign wealth fund kind of kicks in at 2025. What happens with government pension schemes? Does that continue, so they continue to provide a pension, or would that then invariably at some point fall away?
Basically what's happened is there is a private kind of pension scheme or superannuation industry in New Zealand that stagnated for many years, again because, you know, citizens basically expected to get this government pension, and hence there wasn't that great an incentive to save. And plus a lot of employers didn't like the fact that they paid tax on their superannuation contributions. and there wasn't a great incentive for them to offer these systems for their staff as well. So that industry stagnated as well, and as a result, it caused this lack of internal savings, and as I say, KiwiSaver, one of the mechanisms now to address that.